China just gained the upper hand in a war America thought it was winning. Bessent demanded Beijing surrender its currency weapons, yet it was the dollar that collapsed. Now U.S. factories are choking on their own tariffs. Ocean freight from China, down 60%. Retail shelves could run dry in 5 weeks. As Washington scrambles, Trump's ordering Britain to cut ties with China, only to be met with silence. Meanwhile, Beijing's playing the long game. This isn't policy, it's economic warfare. So what happens when your biggest ally stops following your playbook, and your biggest rival starts writing the next one? Scott Bessent's call for China to maintain a strong yuan while the US dollar weakens wasn't just bold. It may have been structurally self-defeating. The US dollar index has plunged nearly 10% since January 2025. But instead of fueling a manufacturing boom, it's inflaming cost pressures across US supply chains still reliant on Chinese components. The tariffs Washington imposed, some reaching as high as 145%, were designed to force China to pivot inward. But with intermediate goods blocked and domestic industry underbuilt, the dollar's fall is feeding inflation rather than exports. You can't devalue into a supply shortage, said Mark Zandi, chief economist at Moody's, in a recent note, warning that the combination of tight inventories and import costs was a perfect storm. Meanwhile, the yuan has remained remarkably stable, devaluing just 3.2% year-to-date, showing that Beijing isn't folding, it's watching. And with $17.2 billion in net short positions placed against the dollar last month, according to CFTC data, global markets are betting Bessent's gamble is already spiraling out of control. The US dollar index dropped nearly 10% between January and April 2025, falling from 105.2 to 94.8, according to Bloomberg. A plunge that was supposed to spur exports, but instead triggered higher input costs for US manufacturers still dependent on Chinese goods. Meanwhile, China's yuan has held relatively firm, slipping just 3.2% over the same period, a stark contrast to the 14.5% devaluation during the 2018 trade war. As Scott Bessent called for a stronger RMB and a weaker dollar to rebalance global manufacturing, Chinese policymakers quietly took advantage. The People's Bank of China cut its one-year loan prime rate to 3.35% in March, fueling domestic demand without currency instability. The dollar decline is now working in Beijing's favor, says HSBC strategist David Bloom, who warned that a soft dollar with no industrial substitute in place creates stagflationary conditions instead of export growth. The contradiction Bessent failed to resolve is now being exploited by China with precision and patience. U.S. retailers are now caught in a countdown they can't escape. As of April 2025, shipping volumes from China to U.S. ports, especially Los Angeles and Long Beach, have dropped by 61%, according to data from Flexport and Panjiva. The National Retail Federation warned in a joint statement that inventory levels across major chains like Walmart and Target will begin to show critical strain within 5 to 7 weeks unless imports normalize. The culprit? Tariffs that now range from 75% to 145% on core goods like electronics, auto parts, and textiles. That's pushed costs up across the board. The average landed cost of consumer electronics rose 32% year over year, according to UBS, while the price of imported furniture has surged 45%. Meanwhile, the CPI for core goods rose 1.1% in March, its sharpest monthly spike since 2021. Signaling inflationary pressure from broken supply routes. And yet Washington insists the tariffs are temporary leverage. If that's true, the clock is ticking, loudly. When Bessent called for a rebalanced global economy led by U.S. manufacturing, he overlooked one foundational truth. America's industrial ecosystem is still under construction. According to the Federal Reserve's March 2025 Industrial Production Report, U.S. factory output contracted 0.6% month over month, while capacity utilization slid to 76.8%. Both signs that reshoring efforts remain years behind. Simultaneously, core producer prices rose 1.3% in Q1, driven largely by elevated costs in construction materials and imported machinery, both of which rely heavily on Chinese suppliers. And the labor market isn't filling the gap. The Bureau of Labor Statistics reported a 17% year-over-year drop in U.S. manufacturing job openings in February. Without stable inputs, skilled labor, or scaled domestic output, the weaker dollar becomes a cost multiplier, not a growth catalyst. As economist Mohammed El-Arian noted in a Bloomberg panel, "This isn't dollar diplomacy, it's dollar dysfunction, and the markets are responding accordingly." Beijing's central bank has shifted into a tactical stance, using the falling dollar as cover to launch targeted stimulus while preserving export competitiveness. The yuan has traded within a controlled band of 7.19 to 7.25 against the dollar since February. Even as the US dollar index slumped, that stability gave the People's Bank of China room to inject over 1.5 trillion yuan, or $210 billion, into state-owned banks via low-interest lending facilities, according to Caixin. Meanwhile, exports remained strong. China's March trade surplus hit $103 billion, led by a 17% increase in shipments to ASEAN countries and Latin America, per customs data. They're effectively buying time to rotate growth inward without triggering capital flight, said Alicia Garcia Herrero, chief economist for Asia Pacific at Natixis. Beijing's playbook isn't reactionary, it's surgical. And by keeping the yuan stable while the dollar drops, China is managing to defend both its factories and its monetary flexibility. The UK now finds itself at the intersection of geopolitical loyalty and economic reality, as US pressure to sever trade with China escalates. Peter Navarro's April 2025 comments in The Telegraph, labeling Britain a compliant servant of communist China, accompanied a behind-the-scenes push from Washington for London to halt Chinese imports redirected from the US market. But the numbers don't support immediate decoupling. In 2023, China supplied 7.3% of UK imports and just 4.1% of its exports, according to the ONS. Cutting those ties would directly hit key sectors, especially electric vehicles, where British EV manufacturers rely on Chinese batteries and components that have no immediate European substitutes. Chancellor Rachel Reeves responded bluntly, stating, "It would be very foolish not to engage with the world's second-largest economy." Meanwhile, the London Stock Exchange is evaluating Shine's IPO, despite bipartisan scrutiny in Parliament, indicating that pragmatism still has a foothold. So the question is no longer whether the UK wants to comply, it's whether it can, without detonating its own industrial future. Despite sharp rhetoric from US officials like Peter Navarro, who in The Telegraph accused Britain of being a compliant servant of communist China, London is resisting American demands to sever ties with Beijing. Chancellor Rachel Reeves publicly warned that disengaging from the world's second-largest economy would be foolish.